everyone. Happy Wednesday. Happy Wednesday. We're back at it here on the channel, and we're going to be talking about some more great real estate content. Thanks for joining me. I'm Joe, and we have a lot to talk about today. So the Fed is at it again. Mr. Jerome Powell is doing very Jerome Powell-y things. So we're going to be talking about what's going on with the Fed and why the Fed funds rate got cut, but mortgage interest rates went up, which is atypical. That is not normal. It's also happened a couple other times, but it's only happened once recently back in 24, but we'll dig into all that when we get there. And then we're also going to be talking about the number of first-time home buyers is like an all-time low, which could be a problem, and specifically for younger people. And I have another article that relates to problems we can face if young people can't buy homes. So we've got a lot to cover. And we also have a fun little house we're going to take a look at too. So we'll start the stream off with that. But before we get into it, as you guys know, my name's Joe, and thanks for hanging out on the channel. Whether you're watching live or on the replay, I do appreciate you being here. If you are here watching live, thanks for being here. And the comments are open, the chat is open. And really, honestly, guys, the best part about live streaming, one of the reasons I do this week in and week out, is because I get to converse with you guys live in person in real time. So if you have any thoughts about the article, if you have any comments, if you have any questions, whether it's about the article or maybe you yourself have your own real estate question, maybe you're thinking about buying or selling, leasing, something about the market, interest rates, whatever it is, and maybe you're just a little sick of ChatGPT hallucinating and giving you wrong answers. Well, the good news is this is your opportunity. Feel free, ask away. Let me know what questions you have, and happy to answer them. Hey, Michelle, thanks for hanging out, hon. So we're going to get into it. Let me turn the music off. Oh, yeah. Also, right down here, there's a little thumbs up icon. If you like what the stream has to offer, and if you guys are enjoying it and find the content valuable, please do me a favor, hit that thumbs up icon. Please like the stream. It really, really does help. And if you're not a subscriber, you should be. But good news, guys. We're running a special promotion tonight. Free subscriptions for everybody who wants them. So you get a subscription, they get a subscription, everybody gets subscriptions tonight. So they're free. Please hit that subscribe button. Really helps me out. Follow the channel. You'll be alerted for new streams. Plus, it helps me reach some more people. So always appreciate if you can like and subscribe. Yes, I know I sound like every other YouTuber. All right, so let's get into it, guys. Let's get into, oh, we got a ton of comments. What's going on? Hey, Killer, I do think soup is a meal, but it depends on the soup. And this goes back to a Seinfeld, right? Did you crumble crackers into it? Is it in a bowl or a cup? Like, what type of soup is it? I think if it's a chowder, it's a meal. If it's chili, definitely a meal. I think something like tomato basil. As much as I love tomato basil and a grilled cheese, the tomato basil itself, not a meal. So let me know what you think. Let me know what you think, Killer. Killer, all right, are buy downs too risky? No, I don't believe they are. I think you're probably talking about like a 2-1 or a 3-1 buy down. And the reason I'd say it's not risky is assuming, you know, your job and financial outlook seems solid. The reason it's not risky, in my opinion, is because you're being qualified at the market rate. So let's just take, for instance, right now, 6.3% is the market rate. Well, if you went to go buy a home, your lender would approve you for a pre-approval, a budget, at a 6.3% rate. So you're approved at that amount. But if you negotiate the buy down in, that means that for the first year, your rate is 2 percentage points lower. So instead of being 6.3, it's 4.3. And then in year 2, it goes to 5.3. And then in year 3, it would go back up to whatever market rate is. Now, if market rate shoots way up, you don't have to worry about it. It's not an adjustable rate mortgage in that sense, where you get the rate at market. No. You would lock in the rate that you have now. So let me know if that makes sense. I don't think it's risky, but it is important if you do execute a 1-year buy down or a 2-1 or a 3-1 buy down, you just have to know, hey, the payment that we have right now, this is a special offer, introductory offer. It's going to go up. So you just got to remember that. You got to remember that. Okay, Killer? Let me know if you have any other questions. Oh, we got so much going on. This is an awesome start to the stream. What are your thoughts on rent control? I think rent control, I'm not a fan of rent control. I think it does a little bit of a disservice to renters because it locks them into their rental, right? And I've seen this in my town. I'm so sorry. I don't know why my stream is so choppy right now. Hopefully it's smooth on your guy. On my end, it's a little frame rate, a little glitchy. Sorry about that. I don't know what that's about. I don't think rent control is good. I think it potentially locks in tenants to a situation that is maybe advantageous to them right now, but if anything changes in the future and they do have to relocate, it could be a real problem. Plus, rent control can also disincentivize small landlords. And then when you don't have small landlords, you end up with corporate landlords. And any renter, first off, all renters, well, I shouldn't say all renters, but most renters hate landlords, which, okay. But if you ask a renter, what type of landlord would you rather have? Would you rather have Stan and Phyllis that live, 2 blocks over, that have owned the house for 30 years and they're letting you rent it? Or would you rather have, Best Rentals Incorporated be your landlord, where you have to go onto a web portal and tell the management company that your faucet's leaky and you can't fix it, because if you fix it, they'll penalize you, and then you have to wait for them. I just think that rent control, there's several different negative factors that go into it, and I just overall think it's not very good. And I'm sure people will disagree with me, and that's okay. Remember, folks, it's okay to disagree with people. It's all right. It's no problem. Let's see. I'm currently making soup for dinner. So I vote yes, it's a meal. Okay, great. What soup are we having for dinner, hun? I think it's a meal. You know this. I think it's a meal. I think you make great soups and I love them. So now I'm curious what we're having. This is going to be good. All right. Well, thank you, Killer, and thank you, Innovative, for those stimulating questions and thoughts. And that's a great way to start the stream. Here we go. We're almost like 8 minutes in, and we're already rolling with some good momentum. So thank you guys for being here. Thanks for hanging out. All right. Killer's got something else. Let's see. I'm seeing a lot of pre-foreclosure postings on Zillow. Should I avoid? Can you make super lowball offers on foreclosure properties? All right. We have a little bit to unpack here. Okay. So important to remember, Killer, is that pre-foreclosure on Zillow is a little bit misleading. If you really, really want to look into like the foreclosure market, right? If you're really like, I want a freaking deal and I want a foreclosure, and I'm okay if, I'm open to areas in my area, maybe my county or my township, depending on where you are. Maybe you're open to doing some work on a property. You might want to check like Foreclosure Radar. It's not really like a property listing website, but it will give you much more accurate intel on foreclosures. The reason I don't like pre-foreclosure on Zillow is because Zillow marks everything pre-foreclosure very prematurely. So like, let's say like you're behind like 1 or 2 payments, Zillow might flag that as pre-foreclosure. Let's say there was like a billing issue and maybe, like the mortgage payment didn't go through because you got a new account, or maybe a check got lost in the mail. Boom. Zillow's like, you're in pre-foreclosure. Pre-foreclosure is not the same as foreclosure. People can get out of foreclosure. And Zillow might label something as pre-foreclosure, and the owners of the home might not even know they're in pre-foreclosure. So you just have to be careful, because, it seems like Zillow, when it comes to the pre-foreclosure thing, is very premature in identifying foreclosure properties. There are better sources out there. Now, to the second part of your question, can you make super lowball offers on foreclosure properties? Yeah, I mean, you could make a super lowball offer on any property, but we had a how to lowball segment on the last stream, and it was really good. You can go back and watch it. It's towards the end of the stream. It was about an hour and a half stream, and it's probably in the last 20 minutes. But Killer, I will give you a very, very quick rundown of my lowball strategy. And and you really should go back and find the stream, because I went on for like 20 minutes and I really gave some really good juicy tidbits on how to make a good lowball offer. But essentially what you want to do is you want to get fully approved for the loan, so that way you look very strong financially to the seller. So not a pre-qualification, not a pre-approval. You want to get fully approved through a direct underwriter. That's the first thing you should do for a lowball offer. Secondly, always account for a 3% EMD. That's earnest money deposit. Now, your area might, you might think, oh, 3%, that's a lot. Don't worry, it's refundable, but you got to check in your area. I am in California. I am 30 miles outside of Los Angeles. Every area is different. So I'm going to speak in some generalizations, but you want to offer a nice full deposit. In my area, full deposit's 3%. And the reason you're going to do these things, the reason that you want to be fully approved, the reason that you want a good juicy deposit is because you want to make the rest of your offer look beautiful, because we already know that you're going to have an ugly price. in the mind of the seller. In the mind of the seller, whatever you're going to lowball them at, they're going to hate. But what our goal is for the seller to go, dang, this price is really low, but the rest of the offer is freaking great. These guys are already approved with the bank. I got a big juicy deposit. I got a 10% down payment, 15% down payment, all of these things, right? And the seller's going, dang, that's a really good offer. Like, man, that's maybe we can work with this. And bingo, now the door is open and we're negotiating, right? Because if you would have just written that offer with $1,000 deposit, no pre-approval, no full approval, really lowballed them, all these things, that seller's like, nah, I don't even want to talk to these people. I don't even want to talk to these people. And negotiation is great, but you can't negotiate if one side doesn't want to talk. Just ask the Democrats and the Republicans how that's going. Different topic, different stream. But so it's important. And the last thing I'll leave you with, Killer, and one of the reasons I'm a huge proponent of direct full approval from a bank is because it allows you to make an offer without a financing contingency. And then you can also make that offer without an appraisal contingency because you still have your inspection contingency in place. And when you're fully approved, you can get rid of that loan contingency because you've already been approved for the loan. So you don't need to tell the seller, hey, I'll buy your house if I get approved, because you're already approved, right? And you can say, and guess what, Mr. and Mrs. Seller, you don't need to worry about an appraisal. And the reason you don't need to worry about an appraisal is because you have your inspection contingency. If you're fully approved, a good direct local lender should be able to get an appraiser out to a property within 3 to 5 days of escrow opening. If you have 12 days or 14 days for an inspection, that appraisal report's going to come back on day 7, 8, or 9, or maybe even day 10. If you have a significant problem with appraisal, which we're not seeing, at least in my market, but every market's unique. But if you have a major problem with appraisal, let's say the home's priced at 400, you bid 350 and it appraises at 330. And you're like, dang, this is a problem. Well, guess what? You can still use the inspection contingency to get out of the deal, because the inspection contingency is like a get out of jail free card. So when you have that full approval, you've now made this offer for the seller where they go, dang, I don't have to worry about an appraisal. Don't have to worry about money. They give me a full deposit. They're fully approved. Because they're fully approved, they can close in 14 days or 17 days. If this is a vacant property, now all of a sudden that old seller is like, my ears are perked. I know you gave me a crappy price, but I can get paid in 14 days. I don't have to worry about appraisal. I don't have to worry about loan. I'm getting a great deposit. Okay, maybe they don't take your offer, but they're going to talk to you. I guarantee they talk to you. I guarantee it. Now, if you lowball them by 150K and then you come back in the stream, Killer, and you're like, Joe, your strategy didn't work, I'm going to say, of course it didn't work because you like super mega lowballed them. The last tip I'll give you is if you are going to lowball and the price is, let's say, 350, don't offer anything with it too. Start at 305, 310. If the property's 375, go for 325, 327, 328, something like that. You want to save money, but you don't want to lose the property if you like it. So, Killer, that was about a 6-minute crash course masterclass on how to lowball. Good. I'm glad. You're welcome. You're very welcome. If you have any questions, or if anybody else has questions about this, you can send me an email, and I'm going to put my email in the chat. The email's in the chat. It's at Gmail. Nothing crazy. Joe Pareca Real Estate at Gmail. So, Killer, if you've got questions about that, you can email me. We can talk further. If anybody else has questions in chat about this or any other real estate stuff, you can always drop me an email. And no, I'm not going to be looking to sell you a house. I'm just looking to provide some good info to people. Hope that helps. Well, hey, I'm just trying innovative. I'm trying to help the people. Okay. I'm a man of the people. I'm trying to help the people. I know everybody is going to be like, oh, dang, he's a realtor. He's a scam person. No, I promise there's a few of us out there that actually like helping people, and we actually like making sure that people get good deals on homes. I like to think I'm one of those people. So That's okay, MH. I'm glad you're here today, right now. It's okay that you missed the last stream. I forgive you. You're one of the regulars. You've got the seat at the bar with your name on it. Don't worry. You'll never be replaced, MH. And one day when I blow up, maybe I'll make you a moderator of the stream. But right now, we only got 8 people watching, so you wouldn't have anything to moderate. But I appreciate you always being here. All right. Okay. I'm going to have, I really try with names. Beauregard Williamson. I'm going to call you Williamson because I feel like I butchered that first name. I'm really sorry if I did. Let's see what we got. My realtor seems to think her only job is to find properties and make offers. Shouldn't she be doing research and running reports? Absolutely. Yeah, absolutely. Without a doubt. Now, it depends. There's a lot that goes into this. So I would say, and I'm going to speak very broadly because I don't know like where you are in your search or your relationship with your realtor. But as a realtor, she should be finding you properties and she should be helping you make offers. That's kind of like 101, right? But also like if there's a property that comes up and it fits your criteria, one of the things I always offer to my clients, especially if we're thinking about writing an offer, is let me run a market analysis. Let me pull some comps. Let me run a market analysis so that I can give, so that A, my client can have the information that they need to have, and B, so that I can guide them appropriately based on actual facts and data of what's going on in that local market. Now, there are some markets I know so well, like my local market here in Laverne, Claremont, Upland, Ontario, my home market in the LA suburbs, where I don't even need to run a report or do research because I live it, breathe it, see it every day. But still, if my client says, hey, Joe, I'd really like to see a market analysis. I'm thinking about making an offer on 123 First Street. I want a market analysis to see what are the other similar homes doing? How long have they been on the market? How long do they take to sell? What's their sale price? What's the average price per square foot? Those are all the things that your realtor should be helping you to understand so that you can determine if you are about to make a good offer on the correct property. So I hope that helps. If you have any further questions or need me to elaborate, Williamson, I will absolutely do so. But yeah, they should be doing some research. They should be running some reports. They should be giving you comps. They should be giving you market analysis. And if you have any specific questions about like an HOA or, hey, Mr. Realtor, when we were looking, we saw that there was some discoloration over here. Do you know what that's about? That realtor should say either, yeah, it's about this because I know it, or they should say, you know what, I don't know, but let me ask the listing agent. Let me do some digging. I'll get back to you with what that's about. So hopefully that answers your question. We got Hui in the chat. Hey, how's it going, buddy? Hope you're doing good. Good to see you. It's been a little while. I'm glad you're here. Glad you're hanging out. Wow, guys, we're rocking and rolling, man. This is like my dream. The first 20 minutes of the stream has all just been chatting with you guys. And this is what I aspire to be one day. So thank you guys for doing this. This is honestly, this is like the best part. Oh, we're having pasta fagioli. That's okay. So Killer, if you're still in the chat, hope you are. Hope you're hanging out. That is absolutely a meal. Like this is like, oh, it's so good. It's really good if you've never had it. It is an Italian soup and it's very, very hearty. Let's see. I'm good. I locked my rate and refinance before the Fed cut. Yeah, that a boy. Get that locked. Get it locked. Save that money. Good. I hope so. If you don't mind sharing, sir, what rate did you have and what rate are you going to? What rate did you have and what rate you're going to? And I just realized my light's all messed up. Hold on, guys. Shut some light. Look, there I am. Hey, guys. My light was all wonky. All right. Let me turn it down a little bit. Hold on one second, guys. There we go. Now we're looking good. All right. Cool. Okay. So congrats on the rate lock. All right, guys. So speaking of rates, that's a great segue. Thank you for that setup. Speaking of rates, we're going to be talking about why did mortgage interest rates go up? Why did they go up when the Fed funds rate got cut? Now, we've talked about this before. Very quick refresher. The federal funds rate is the overnight rate at which banks lend money back and forth to each other. It is not the mortgage rate. However, the federal funds rate typically tends to move almost in lockstep with the mortgage interest rate. So federal funds rate, mortgage interest rate, not the same thing, but oftentimes very connected. Every once in a while, the Fed funds rate will get cut and the mortgage interest rate will go up. We saw that for the first time in a very long time towards the end of 2024. And we just saw it again. And we're going to dig in as to why that happened. So we're going to go to this one. Oh, I forgot. Guys, before we dig in, I got to show you this really cool house. I call this the mullet house. All right. Well, you know what? We were already on the Fed thing. We'll come back to this at the end. We'll finish with the mullet house. Stick around. You guys need to see this one. It's pretty wild. But we'll go to the Fed thing for now because that's where we're at. That's where we're at. Let's see, how'd you do? I had 6.9, Reho has a 5.99 with no points. I also dropped PMI. Oh man, and only for 1250. That's great. I mean, I don't know what your PMI was per month. It depends. There's a lot, credit score, amount finance. But anytime you can get rid of PMI, because your PMI, low PMI is like 70, 80 bucks a month. And like normal PMI is anywhere from like 150 to 250 a month. So even just by getting rid of that PMI, your refi is going to pay for itself in like a year. So that's wonderful. Plus you dropped a whole freaking point. I mean, that's great. That's awesome. That's amazing. You're coming up on some big savings. Congratulations there, buddy. Congratulations. Wow. I got audio for that. Hold on. Intense applause for that. Well done. All right, guys. Let's get back to what we're doing here. All right. So why didn't mortgage rates fall after the Federal Reserve rate cut? Make this a little bit bigger. We've seen it before, but it's still jarring. The Federal Reserve lowers short-term interest rates and mortgage rates inexplicably increase. It happened in 2024 and again with the first Fed cut of 2025 in September. Will it happen again with the latest Fed action? Now, this was as of October 30th, so pretty current here. I need 5 months to recover the fee. What a beautiful return on investment. 5 months and you've already broke even. And then every month after that, you're saving money. Oh, congratulations. That is wonderful. That's what I love success stories in real estate. That's a good one. Congrats. That's great. All right. We got to get through all this stupid ads here. All right. What happens when the Fed lowers interest rates? First of all, the Federal Reserve and mortgage rates are working on two ends of a timeline. The Fed steers short-term interest rates and mortgage rates are influenced by long-term bonds, which is why the 10-year T-bill, the 10-year treasury is like that's like what you should watch because that's going to dictate what happens with mortgage spreads and therefore mortgage interest rates. The Fed funds rate falls. That's the interest rate charged to banks for overnight loans from other banks. The prime rate falls. That is the interest rate financial institutions charge to their most favored customers. So think about like interest rates on your high yield savings account. Savings account rates fall, as do interest rates paid on certificates of deposits and checking, brokerage, and cash management accounts, similar to the prime rate. Depends on your banking, what term they use. Loan rates fall. That can include personal loans, home equity loans, and home equity lines of credit. So some good news for maybe the HELOCers out there. If you're someone that needs a HELOC because maybe you can't afford to move, but you can afford to pull out some money and maybe do a new kitchen or add on another bedroom and bathroom for your expanding family, your interest rate probably just got a little bit more reasonable. A little later, other short-term rates move lower, such as credit card interest rates. Mortgage rates are different, and here's why. Before we get into that, I see we've got a comment from Killer. What we got, Killer? I went to an open house that felt like a happy hour party. People standing around chatting. Is this a trick realtors use to make people think a house has lots of interest? Well, I would say, I mean, it's not a true. Okay. I suppose that a realtor could hire straw buyers to hang around their open house and make it seem like, oh, it's very lively. I've never heard of that. I've never seen an agent do that. I've never knowingly heard of an agent doing that. I've never been to an open house where I got that vibe. But agents do love when there is good energy at an open house. In fact, that is why some agents will only do 1 to 2 hour open houses. And it's to compress and get a lot of people into the house so that when other people show up, they're like, dang, it's a hot property. Like, we're going to have to be like competitive here. Whereas a lot of agents that do like the 4, 5, 6, what I call marathon open houses, a marathon open house is anything over 3 hours. So once you get into 4, 5, 6, 7 hour open houses, and I've seen that, we're open from 10 a.m. to 4 p.m. You're like, whoa, what are you, are you a nail salon? What? I thought this was an open house. So it's possible, but it's unlikely. If there's people hanging out in an open house and they're really just hanging out, chatting, you're probably in a neighborhood that's got a lot of like active community members. Like, there's a lot of neighbors and all the neighbors know each other. And chances are they're just chilling, they're hanging out. And if that agent is maybe serving some champagne or wine at the open house, that will certainly keep people around. Obviously, people like food and drink, and when it's free, they really, really like it. So to answer your question, probably not a trick or tactic that the realtor used on purpose, but they probably did, invite neighbors, advertise maybe some food, some treats, maybe raffle prizes. Some realtors are like, hey, if you just show up to my open house and give me an email, I'll enter you for $25 to Starbucks. And people are like, shoot, I'm there. So that's more likely what it is. Yep. More likely, most likely nosy neighbors killer. Yep. Bingo. Robert G in the house. We got Robert. How you doing, Robert? It's good to see you. Thanks for hanging out on the stream. Hope you've been well. See here, Maryland, most open houses are 2 hours. Yep. And Maryland's because it's a hot market. You still got a lot of hot properties in that area, the kind of Northeast, New Jersey, Maryland, New York, still hot, Ohio, all those areas. So yeah, probably really only need 2 hours and compress all those people and make it look really, really busy. I do open houses for 2 to 3 hours, depending on the property. And if it's a really hot property, I'll do the open house for less, because again, I want everyone to show up. I want everyone to come at that one time, and I want the place to be packed. I want everyone there. I want it to make people seem like, man, this is a lively place. There's good energy here. And if I want the house, I got to make a good offer. Okay, let's continue on. Mortgage rates are different. Here's why. Mortgage rates are a longer-term debt. As anyone with a 30-year home loan knows, that's a very long debt runway. The fixed rate you pay is evergreen, with a margin built in to last through many interest rate cycles. That means it's priced to a longer-term benchmark, such as the 10-year Treasury, right? And you might have heard things about mortgage spreads. One of the guys I watch and listen to almost on a daily basis is probably one of the best mortgage guys, housing analysts out there. His name's Logan Mohtashami. He's with Housing Wire. Very, very good if you're into like the nuts and bolts of housing. And his main focus is mortgage spreads. And when we talk about mortgage spreads, we're talking about the spread between the 10-year T-bill and the 30-year interest rate. So this gap is the spread. And what we don't like is when those gaps are far apart. That's craziness. We want them to be closer together, more stable, and usually lower mortgage interest rates, usually. The bond market generally reacts to longer-term events, such as inflation, employment, and macroeconomic trends. And of these things, what have we been talking about recently? We've been talking about inflation a ton in the last 24 months. And employment is also starting to gain traction in the news media and news cycle. So makes sense, because the bond market, which is attached to the mortgage interest rate, is a little bit more concerned with inflation, employment, and macroeconomic trends. Okay. Sometimes mortgage rates fall after a Fed rate cut. Sometimes they don't. Many times they'll decline in expectation of falling short-term interest rates in the weeks leading up to the Fed meeting. Then occasionally they bounce back up. That's what we call baking it in. I don't know what's going on with my video. Does my video look okay for you guys? A little choppy on your end, because I see my little preview here. I don't know what the deal is. I don't know if the internet is a little glitchy, but I'm really sorry about that if you guys are seeing it freeze up a little bit. So that is why the Fed funds rate doesn't really accurately reflect mortgage interest rates anymore. It's more the 10-year the 10-year Treasury. All right. Well, thanks for sticking through it. Killer, I know you're new here. This doesn't normally happen. I promise you. My production value is usually pretty decent. So I'm not exactly sure what that's about. Hey, let's blame YouTube, right? Let's blame Google and YouTube. Don't blame me. Don't blame the internet. It's freaking Google. I don't know what it is, but I'm glad that you guys are hanging out. Thanks for being here. In all recent Fed's cut, mortgage rates went up immediately. Yeah, and that was interesting because I think what happened, and maybe they'll address this in the article. I haven't read all the way to the bottom yet, but this is kind of what I think happened here. I think what happened is they like this article just mentioned, they baked in the mortgage interest rate cut. They said, "Oh, the Fed's going to lower rates. We're gonna cut mortgage interest rates in anticipation of." That's extremely, extremely, extremely common. In fact, I would say that is more common than not. And I would say that a lot of times, those cuts are baked in. And then what happened this time is the mortgage market baked in that rate cut. The rate cut, of course, like we all thought, happened. Then then Jerome Powell gave a little speech and said, "Yeah, we'll cut the rates, but we're not so sure about December." And so we kind of built in this little bit of doubt, this little bit of, yeah, we cut rates, but might not continue. And maybe we're still concerned. And I'll tell you, that will freak the bond market out and investors out. They hang on to Jerome Powell's words, every single word. They hang on to it, and they're looking for clues of where things are going to go. And that's why when Powell talks, rates tend to move. Rates tend to move. Hey, Bert, how's it going? Thanks for joining the stream. Should we save our questions until the end of your mortgage rate segment? No, brother. You can interject with your questions at any time. This channel, this stream is very informal. So we're just kind of hanging out, chatting. And when you guys don't have questions, I hit the article. And then when you guys have questions, I drop the article and we'll discuss that. So feel free, Bert, anytime you got any questions, you can fire them off. I don't disagree with you, MH. I do not disagree with that at all. I do believe the next 12 months are going to be very, very interesting. We'll see what happens, especially now that the midterm elections are over. There's just a lot going on, as there always is. So it will be interesting. Innovative. Audio is perfect. Video is good. You could have showed some, but it's all right. Oh, innovative. You always keep me chuckling, dude. Oh, man. I'll take that viewer suggestion into account for the next stream. All right, guys. So in fact, weekly 30-year fixed mortgage rates generally began dropping on May 29, 2025 from 6.89% all the way down to 6.26% by September 18th. Nice healthy drop in, gosh, it's not quite 6 months. The Fed rate cuts on September 17th. The Fed cut rates on September 17th, and rates bounced up to 6.3% on September 25, which is basically currently where we're at right now. All right, Bert, do you have any takes on HOA fees? They're annoying, but there are some benefits. Yeah, brother, I feel you on that. I am not an HOA guy personally. They have their place, and like most things in governing bodies, when they are first made, they're made with very good intentions. And usually those good intentions come through. And as time rolls on, it evolves. And when HOAs were originally brought up, they were very kind of low key, just the community neighbors that got together and said, hey, like, let's all chip in and have a park here, and then we can all use it. HOAs were kind of informal, and then they kind of snowballed. And now HOAs are like, they'll take a ruler to your grass, and they're like, oh, it's over 4 inches. We're going to give you a fine. You got 3 days to cut it, or we give you a fine, right? And if you don't pay the fine, we'll put a lien on your house. Now they're a little crazy. Overall, my biggest thing with HOA fees is that, first off, if it's an investment or rental, you can write that HOA fee off. Very good for taxes. If it's your primary, you cannot do that. I would say that the most important thing with HOA fees is just to make sure, like, hey, is what I am getting for the fee, does it make sense? I'll give you an example of an HOA fee that doesn't make any sense versus an HOA fee that I think makes great sense. And these are both real examples in my community. So there's one community in my area where the HOA fee is $460 per month. Guess what the amenities are for that? You can't guess because there's none. There's no pool. There's no spa. There's no barbecue. There's no clubhouse. There's no walking path. There's no gym. There's no any. I'm sorry. They have what's called a green belt, which is this strip of grass that kind of winds between the condo complex. So that is what you're getting. Now, obviously, the HOA, it's a condo complex, so they're taking care of all the exterior of the property. So roofs, that's not the owner, that's the HOA. Exterior stucco, termite work, HOA, all that stuff. So yeah, you don't have to worry about that. But I would say that that's the biggest thing is make sure you're getting the bang for your buck. An example of a good HOA, just sold a home, Creekside in Ontario, California, great HOA. For like $78 a month, they have multiple pools, multiple spas, multiple parks. They have clubhouses, multiple clubhouses, tennis courts. I think they even have pickleball. I mean, it's really, really quite nice. And the other side of Creekside has HOA dues of $99 per month, and you get all the same stuff, but you also have access to a private lake. So that's a great example. I mean, if I was a homeowner in that area, I was like $99 and I get like 2 pools, 3 pools, 2 spas, a lake, clubhouses, walking paths, jungle gyms, parks for the kids. I don't know. That seems like a pretty good way to spend $99 a month, I think, right? So I think that's my take on that. Bert, that was my very long answer to your like pretty short question. But what do you think? Are you in an HOA? Oh no, what happened to my camera? My camera's really freaking out. I don't know what's going on tonight, guys. If it keeps messing up, I got an alternate that I can go to. I can go to my backup camera. There you go. See, gated security is a good amenity for HOAs. Yep, gate and what's the even better one is gated and guarded security entrance, which is really nice. There's actually a little guy that sits there and makes sure that people aren't like 3 cars aren't going in at one time when someone opens the gate. But Bert, yeah, what's your experience with HOAs? Are you in an HOA right now? Do you like it? How much is the fee? Are the amenities worth it? Let me know. And thanks for being here. Thanks for hanging out. All right. Back to what we got here. It's not the Fed that will move mortgage rates. It's the economy. Yes, very true. It's so funny. President Trump is like, Powell's got to get those rates down. Powell's got to get interest rates down. Housing. I don't know if President Trump understands. I would like to think that he does, but Jerome Powell doesn't choose the mortgage interest rate. The market does. Macroeconomic factors do. So it's not up to Jerome Powell to lower the interest rate for mortgages, but it is up to Jerome to lower the federal funds rate. But as we've seen, sometimes a lower federal funds rate doesn't mean a lower mortgage interest rate. What will it take for mortgage rates to continue a downward trend? Spoiler alert, we need lower mortgage spreads. With rates drifting higher following the Fed's rate cut, softer labor or inflation data will be needed to reignite hopes for lower yields and mortgage rates. Loan Depot's head economist, Jeff Dergurahian, said in an analysis, it's not the Fed, it's the economy. Yep, bingo, MH. Increase inflation, raise the 10-year. Yep, that's exactly it. And what do you get? Higher rates. It's not the Fed, it's the economy. Don't pin your home buying hopes on short-term events, day-to-day trends, and all other things out of your control. Once you have your down payment in hand, a home buying budget ready to go, and an idea of how much house you can afford, make a real life plan to buy a house. Know the mortgage interest rates range you can handle and have your list of potential mortgage lenders lined up. Then don't look back. So now what we're going to do is I want to go to Mortgage News Daily. And we're going to go to this. So there you have it, guys. Whoa, it's going to take us way down there. So we're at 6.37. We were flirting with 6.0% just about a week ago. And then Powell had to open his mouth, and there you go. But you can still get, I know buyers that have gotten rates at 5.99. In fact, we had a guy refi in the chat at 5.99. So that's good. But even at 6.37, it's one of those things where you can probably get that rate a little bit lower if you're a well-qualified buyer, especially if you pay points. So I just want to read this really quick. This is going to be a little bit more like technical jargon because it's come from Mortgage News Daily, but it'll be some good info. Try to make this as big as possible for you guys. All right. Mortgage rates near 2-month highs after today's econ data. This is as of today at 4:08 p.m. A common recent refrain is that the bond market, which dictates interest rates, see what I talked about, the bond market, 10-year treasury, is having to make do without many of the most important regularly scheduled economic reports due to the government shutdown. Remember, no Bureau of Labor Statistics, no inflation numbers, no core CPE inflation, none of that. We don't have any of that because the government shut down, because we have a bunch of children in Washington, D.C. that can't get along and play nicely with each other. Oops, I just said that out loud. While this means rates must fly blind on many of the days that would normally coincide with these government economic reports, there are other days that still play host to top-tier non-government data. So we don't have unemployment data, but we do have payroll data from payroll giant ADP. So that's, one of the biggest payroll outfits in the entire nation, maybe the world even. And so they obviously have a good handle and a lot of data on who they're no longer doing payroll for, what employees, which means job loss. So there are things that we can look at. Today boasted not one, but two such reports. Unfortunately for rates, both reports were unfriendly. Rates tend to benefit from economic weakness. As such, when reports are stronger than expected, it pushes rates higher, all else equal. Today's reports were both stronger. ADP's monthly employment tally came in at 42,000 versus a median forecast of 25,000. This isn't an especially large margin of victory, but it was enough to cause weakness in bonds earlier this morning. Less than 2 hours later, the most widely followed report on the health of services sector also showed stronger than expected results. Bonds continued to weaken after that, ultimately forcing lenders to raise rates back to levels just under those seen in September. If things had been a little bit worse, we'd be at the highest rates in just over 2 months. As it stands, we're close enough. Mortgage News Daily's 30-year fixed index rose to 6.37% today. September 25th level was 6.39, and that's as high as we've been since September 4th. In the bigger picture, rates are still much closer to 2025's lows as opposed to the highs, so that's good. But there's been a palpable shift since the Fed meeting at the end of October. And this is a great point. They're always revising numbers a month later. And it's true. Obviously, they're trying to crunch some big data from a big country. And there are going to be some anomalies in the data, and there are going to be some revisions. But every once in a while, we get these major revisions that are that's way off. We had that earlier this year with a jobs report where it was revised much lower. So that is something to think about too. But not having the data is a little bit of a problem. All right. So how does this affect home buyers though? Well, number of first-time home buyers hits a new low, survey says. NAR report says market is split with all cash buyers at an all-time high. So it's a good segue because these elevated mortgage rates are keeping the first-time buyers not out of the market, but severely suppressed because the affordability issue, right? So you have very high prices. You've got mortgage rates that still haven't given a lot of relief to a lot of buyers. And there you have it. First-time home buyers are kind of stuck. The reason that it's just relating to first-time home buyers is because move-up buyers, people that have a home to sell to help afford their next purchase, i.e. not first-time home buyers, well, they were able to reap the rewards and the benefits, most likely, of pre-COVID pricing and COVID-era low interest rates. So they're in a wonderful equity position. They probably have a lot of equity. In fact, was it 40% of all homes in the United States are completely fully paid off. And of the 60% that have mortgages, it was another 40% have interest rates under 4%. So those owners are doing quite well. And yes, no one wants to give up 3 or 4% to go to 6.3%. But if you're sitting in your house and you bought the house in 2017, and maybe it was you and your wife or husband at the time, but now it's 2025, and maybe you have 2 kids, and there is now a third one on the way. And that 2-bedroom condo, townhome, bungalow, starter home, not cutting it anymore. Well, of course, you don't want to take an interest rate that's 2.5 points higher, but you contact your local real estate agent, your trusted advisor, and you tell them you're thinking about this, and they go, hey, You bought that home for 400. It's now worth an easy 650 to 700. Like you've got a ton of equity. Well, they're going to go, hey, I know the rate's higher, but if we sell this house, we can put like 25% down, 30% down, and our payment maybe isn't that much different than when we only had 5% down, right? So that type of thing is something where you have people that have the equity that will help soften the blow of taking a higher interest rate. And when you combine that softened blow with the high need to move, those are the people that are going to be able to buy and sell houses. Whereas when you have first-time home buyers that maybe want to get into a home, but they don't need to buy a new home because their family is expanding, they don't have the equity, interest rates are high, they're just going to go, forget it, I'll just keep renting. It's just easier, cheaper, depending on, where they are. All right, Robert, what you got? Date the rate is turning out to be a long-term relationship with these persistent high rates. And that's exactly it. I am so glad that I never ran with that marketing shtick. It's not a good one. Hold on, I'm having some problems here with my mic stand here. There we go. It's really not that turned out poorly, very poorly. It's going to be a long-term relationship. I don't see, the people that got it, 7.2%, 7%, 7.5%, they're able to refi. Like he was able to refi, so that helps. But yeah, you're right, Robert. Yeah, it's turning out to be a much longer-term relationship. And hopefully we'll get some relief soon for people that bought high, want to refi, and home buyers in general. All right, let's take a look at this article from Maura Ritter. It came out November 4th, so just the other day. Make this a little bit bigger for you guys. Their font is like really thin on this. There we go. A tale of two markets is unfolding for home buyers in the United States. The share of first-timers is at a new low, while the number of buyers paying in cash is sitting at an all-time high. Well, of course it is. Interest rate. People aren't buying because interest rates are high. If you got cash, you don't care what the interest rate is. So of course, duh. Between July 2024 and June 2025, the share of first-time home buyers declined to 21%, according to the National Association of Realtors 2025 profile of home buyers and sellers released on Tuesday. That's the lowest shared. That's the lowest share recorded by the survey that started in 1981. So declined to just 21% of home sales were first-time home buyers. We need that number up. I don't know how we're going to do it. We need interest rates lower. We need better inventory, but we've been yelling that for like the last 3-4 years. So Drew V, we got Drew V in the house. How's it going, Drew? Thanks for hanging out. Hope you're doing well. Will home prices continue to go down if the AI bubble pops and the economy crashes? Sorry for the bleak question. Hey, Drew, let's talk about it, buddy. Let's talk about it. I do believe that AI is a little bit frothy at the moment. I'm never going to be one that's going to say that there's going to be a market crash. That's over my pay grade. I'm not going to say that there can't be one. Obviously, there totally could be. The AI bubble does certainly remind me of a .com bubble that we had. And I started to really get alerted to it when we had these kind of really circular deals in AI where OpenAI is going to invest into Intel, and then Intel is going to invest into, oh God, what's the one? I can't think of it. Oracle. And then Oracle is going to invest back into OpenAI. And then the United States is going to invest into all of them. I don't know. It just seems kind of weird. So, will home price continue to go down if the AI bubble pops and the economy crashes? Typically, Drew, it depends. Typically, when we have an economic event that's negative, home prices stay pretty stable, and interest rates go down, which can then lead to helping kind of keep the real estate market afloat for people that have jobs. So it depends on the scale of the crash. Like obviously if we were to have another 2008, which I'm an adamant believer that we will not have another 2008 just because things are just so much different. Remember, there's 40% of people that don't have a mortgage payment. 40% of people are free and clear on their home. So if those people lost their jobs, probably wouldn't make a difference to them when it comes to their housing. Now, over time, if they lost their job for long enough, yeah, maybe if their property taxes are really high, that could displace them. If their insurance is really high, maybe that could displace them. But if they own the home outright, they could cancel their insurance because you don't have to have homeowners insurance if the property is owned outright. Now you got to have insurance if there's a loan, but not if it's owned outright. I don't know what's going on. Sorry guys with the camera. I don't know what the deal is. So it's very interesting. If the AI bubble pops, it will depend largely in part with how big the bubble got. I think that it could be a problem, but if the AI bubble pops and AI turns out to not be what a lot of people think that it could be, that could also mean that we are ripe for job creation. Right? Because if we're like, oh, actually AI doesn't really it's not panning out to do what we want, then, they might go, oh, we got to replace this AI with more people. And then we got to hire, and then we have an economic boom. So Drew, I hope that answers your question. If you have a follow-up question or anything like that, let me know. I think overall that was a very ambiguous answer. I'll try to put it into summation for you. I think if there is a low to mid-level AI boom, I don't think it's going to be a problem for the real estate. If there is if the AI bubble is very big and bursts and then starts to take down like NVIDIA and Oracle and affects Intel and then affects the United States government and their investment, then I think, yeah, we could have a little bit more of a problem. But we'll see. MH, AI bubble will pop, and AI is now in so many segments of the economy, it's going to hurt. And it is true. AI is integrating into a lot of different stuff, and there's a lot of different people banking on it. Major investment firms, things like that. So we'll just have to see. I'm telling you though, I do believe that AI is frothy. I do believe that AI is a little, I don't want to say overvalued, but I think that people are putting a lot of stock and weight into it. And we'll see what happens. We'll just have to see. Drew, all right, what I'm trying to get at is, should I buy now or wait for the inevitable recession? Okay, Drew, good question. So here's my take on this. If you are in the financial position, so let's say you have, you got the down payment, you feel like you've got the stable job. Hold on. I'm switching cameras, guys. I'm not doing this to you guys. Hold on 1 second. You're going to see a bunch of stuff go crazy. And I'm going to lose you, but it's okay. I trust me, Joe is still here and with you. He's still here with you. We're just going to do this. And then don't worry, I'm going to see, look at that. Just like that. We're back. Told you I wouldn't leave you guys. Got to just make an adjustment to my tripod for this camera because it's a little bit larger. Hi everyone. I'm back. Did you miss me? Here I am. Let's see if this works a little bit better. We'll see if this works better. Okay. All right. So back to what we were doing, back to our regularly scheduled program. What I'm trying to get straight by now. Okay. So let's say if you've got the down payment, right? And you feel like, hey, stable job. If you're in a relationship and you're buying a house with someone else, doesn't have to just be girlfriend, wife, husband, boyfriend, but if you're buying a property and someone else is involved, whatever that relationship is needs to be stable. Last thing you want is a year or 2 or 3 down the road, that relationship dissolves. And now you're like, oh crap, can't afford the mortgage payment or whatever. Because if you have to sell a home in the first 7 years of ownership, there's an extremely high likelihood you're going to lose money. So if you have good down payment, if you feel like your job is solid, if you feel like your financial ground is solid, and if you feel like whoever you're buying the home with, that relationship is solid, or if you're doing it by yourself, huge kudos to you, then I would say if you find the right home, pull the trigger, man. Pull the trigger. If there is a recession, that doesn't necessarily mean that home prices are going to go down. But if there is a recession, there's a very good chance that interest rates will go down and you can refi. Right? And you can refi. Now, yeah, the price that you pay for the home is the price that you pay for the home. But I will say that, if you see the home and it comes up and everything lines up for you, Drew, I would pull the trigger sooner rather than later, man. I would not worry about trying to time the market. And I know that I'm a realtor telling you this, and I know that a lot of people think that, oh, I just want you to buy something. Listen, I don't even know where you are, man. I'm not going to make a cent off of you buying a house unless you decide to do it within like a 30-mile radius of me and you like me enough to use me. But I've seen so many examples of people losing out on equity. Equity is the big one. Tax incentives. I mean, all sorts of things. And also too, like owning your home, not worrying about rent going up, being the master and commander of your own domain, not having to worry about, am I going to get served a 60-day notice to vacate? Is the landlord going to knock on my door and say, hey, guess what? My son's moving in 2 months. Thanks for paying me for the last 7 years, right? So there's a lot of things that go into it. Drew, I hope that answers your question. I know I give long-winded answers. I hope that helps. If you have more detailed questions or a follow-up, please rip it in the chat. Let's do it. MH, not to mention AI is a myth. Ask AI what day it is. The answer is amusing. I'm going to do that. Yeah, MH, we've talked about this a little bit on the stream. You and we've talked about this a little bit, and I don't disagree with you. I think AI is good at doing a lot of things, and I think AI is bad at doing a lot of things. And I think that we're coming to an age where people are going to starve. Humans are social people, social animals, and I would say that I think we're going to get to a point sooner rather than later where people are like, no, forget your AI chatbot. I want to talk to somebody who actually freaking knows and can think critically. I think we're going to get, I think we're, right now AI is kind of amusing. It's kind of fun. It's kind of, it's kind of cool. It's cutting edge, right? The affinity is still there. It's a shiny object, but I think we're going to get to a spot sooner rather than later. We're like, no, I don't want to go to ChatGPT and ask ChatGPT about something. I want to talk to an expert, to an individual. Do I think that ChatGPT is going to dissolve into the background of the universe? No, it's not going to. People are still going to go to it. They're still going to use it. It's a phenomenal tool for a lot of things. But for a lot of things, AI is just not going to be able to replace the human experience, the human touch. AI doesn't have empathy, sympathy. AI can't care for things like a human can. So that's my take on that. Robert G, I think housing will lead the economic recovery after whatever eventual correction we have. Don't disagree. I don't disagree. Interest rates will drop for sure. Deflation. It's the ultimate job creator. High pent up demand. Yeah, I don't think you're wrong at all. I do think that if we do have some type of reset or correction, I do believe that, and housing has always been the bedrock, the foundation of the American economic cycle and standing. And that's why I think housing makes up like 21% of our GDP or something. Just housing alone does that. So I'm in a state of rage because your camera didn't have 60 frames per second the entire stream. Dan, I'm so sorry. You can email me your complaints. I'll forward it to my manager and let my management company take care. I'm so sorry, Dan. Please forgive me. Please still like and subscribe to the channel, guys. Please still like and subscribe, Dan. Thanks for hanging out, Dan. Thank you for hanging out. All right, guys. Well, my new camera seems to be working pretty good. I don't know what the deal is with the old one, but we're rocking and rolling. Now, the new camera I'm on is my cell phone, and I don't believe I silenced notifications. So if someone calls me right now, the camera's going to shake because it's going to vibrate. So we'll see if I get any phone calls. All right, let's get back to first-time homebuyers dissolving. All right. A tale of two markets is unfolding for homebuyers in the United States. The share of first-time homebuyers is, we already did that. At the same time, the median age for first-time homebuyers rose to 40, another all-time high, and a stark contrast from the 1980s when the typical first-time buyer was in their late 20s. Now, this is not the best stat for housing and for home ownership in the United States. But I don't think it's as grotesque or bad or as they maybe make it out to be. Guys, the 1980s was 40 years ago, right? 1980 was 45 years ago. The 80s were 40 years ago. It's a long time, guys. A lot changes in 40 years. And I don't think it's a big surprise to people that it's pretty well known now that, things in life are happening a little bit later, right? People are getting married later. People are graduating college later. People are starting their careers later. People are buying homes later. So I don't think this is like the shock and awe that they're saying. And of course they do late 20s. Of course, they don't put like, oh, when they were 28, they put late 20s. They want it to look like, oh, it was 20, oh, to 40. I mean, there's really not that big of a spread here. But it would be better if this number was lower, because that would indicate that affordability and the barrier to home ownership is much lower, right? So you can see share of first-time buyers sinks to another all-time low. So look at this is in 85, it's sunk low 30%, and we're at the lowest we've ever been. 21%. We had a little spike up here in 2023, which is interesting. I don't know if that was just, and we had a little spike in 2021. This makes sense because this is when interest rates were very low, and 31%. Yeah. So, they were ticking pretty good there. And then just with interest rates, they just got hammered. On the other hand, 26% of surveyed buyers said they paid for their home in cash. That's the same as last year's survey, and it's still the highest share on the record of the report. Moreover, of those surveyed who were repeat buyers, 30% paid in cash and did not finance their home purchase. Yeah, so all cash buyers holding steady, which makes sense. You got people that are selling their paid off homes, and I personally, I don't know. I mean, if I owned a house cash and then I sold it and had a bunch of cash and then needed to buy a new house, I would take a small loan. I would probably, depending on the price, right? Like if I sold a house for 500, I found a new house that was 500, I would probably put down 350, and then I would take a small mortgage where my payment's like $500, $600, $800 a month. And then I have liquid cash. I've got 150,000 that I can either invest, maybe go out and buy another investment property, use that as a down payment, use that as an investment. I just want to freaking buy a Ferrari, right? Got to live a little, right? Maybe I want to go to Europe, do all sorts of stuff. That's what I would do. All told, it's a continuation of an underlying shift that has manifested in the housing market over the last several years. While homeowners have watched their wealth grow, first-time buyers are more frequently facing insurmountable barriers to home ownership. Where's Drew? Paging Drew. If Drew is still in the chat, if Drew V is still in the chat, this is a great reason why when you can buy, you should, because the cost of waiting will be expensive. You're going to sacrifice the growth of the wealth. All right, he's here. Good. He responded. A good listener. And the barrier to get into the housing market is likely only going to get higher as time goes on. And you have a cost of waiting. And if you're curious about that, you should look into a cost of waiting analysis. A good lender can do a very good analysis, although there's things online where you can like plug in a calculator and you can figure out the cost of waiting. But just remember that every year you spend waiting to buy a home, that's a year you've missed out on equity. That's a year you've missed out on mortgage interest write-off, which the first year has huge write-off potential. That's another year that you've paid rent. That's another year that you have been paying rent and therefore been unable to save as much as you could for the down payment. So to kind of piggyback off the question, it's only going to get harder. And I know that that's a very like realtor salesy thing. Like, oh, if you don't buy today, then it will only be harder to do it tomorrow. That's not what I'm getting at. But the data is there and we know this, and you can look at the numbers and you can run it. If you've got the money, if you're comfortable with the payment, if your relationship with whoever you're buying the home with is on stable ground, and you find a home you like, you probably should think about pulling the trigger if it makes sense. Drew, if you have any other questions or you need any other advice or need resources, man, my email's in the chat. I'm going to put it in the email or in the chat again. You're welcome to email me. Again, I'm not going to try to sell you something. I don't even know where you are. But if you just have more questions, you can always pop into the chat here. Or if you ever want to talk or have something really specific and you want to take it off stream, shoot me an email. Always happy to help. All right. Homeowners are staying in their homes for longer and building more equity. This year's survey also revealed that homeowners are staying in their homes for longer. The median number of years sellers own their home was 11 years, an all-time high. And we love equity. Now I've got my anti-equity bros out there. they're usually best friends with the crash bros, and they'll tell you, "Oh, but equity, schmequity, you can't use the money, you can't get the equity. You got equity in the house. How do you get the cash to use it? What are you going to do? Refinance and pay a higher rate? Well, you could, but here's the interesting part. Equity is how most of the world's millionaires and billionaires operate. Equity in businesses, equity in stock, equity in investments, equity in real estate. And that's how people are worth so much money. So on one side, on one side of their mouth, they're like, equity doesn't matter when it comes to real estate, and you're wasting your money in real estate, and buying a house is a scam, and only realtors want you to buy a house. Only fools and realtors buy houses. But they're the same people on their side of the mouth will go, oh, but look how much my stock portfolio has grown, and look how wealthy I am. Well, that's the same thing. You have unrealized gains. You don't have it till you sell it, right? So I know that it's easier to sell stock. I get it. I understand there's some nuances here, but equity is good. It comes as home buyers' equity has grown due to rising home prices, giving repeat buyers greater power in the market, which is kind of what we just talked about. Those repeat buyers are being able to harness that wave that is lifting them up, giving them equity, and it's allowing them to go out and buy that move up home. Now, that's what my wife and I did. We bought our house in 2019, our little bungalow. It was a piece of junk, but I love that house. And we fixed it up, and it was great. It was a great house. And we fixed it up, and the market went crazy because of COVID. And then we were able to buy a house that, number one, if we didn't buy the first house, we wouldn't be able to buy the house I'm sitting in right now. And number two, if I had to buy this house again today, I would not be able to do it. That first house, buying that first house at that time, and then identifying the opportunity to buy the house I'm sitting in right now was all because of that first property and building that equity, getting that equity up and having that. Obviously, the market did a lot of that. We invested some money into it, and we made it really, really pretty and nice. And we ended up selling it, making a lot of money, and we were able to come to our new house, put down a very healthy down payment. Our payment went up because our home is much more expensive than our starter home, which I think a lot of people are in that position, right? The second home usually is bigger and more expensive than the first. And I wouldn't have been able to do that without the power of equity. Equity is an amazing thing. While the median down payment size for all buyer types rose in this year's survey, repeat buyers led the way with a median 23% down payment from all that equity. So they got 23% from all that equity. The same as last year, and the highest since 2003. So repeat buyers putting down 23%. Average of all buyers is 19. Look at this, guys. First time buyers, 10%. Guys, you don't need to get to 20%. Stop. Drew, another thing, I'm going to pick on you. You're so participatory in this, and I so appreciate you being here. Drew, I know that, you're talking about first time home buyer. A lot of first-time home buyers are like, I got to get to 20%. That's what everybody says. I got to get to 20. I got to get to 20. I got to get to 20. Well, I got news for you. 20% on an average price or higher home. Whoo-wee, that's a lot of money. Average price home is almost, it's about $430 something thousand. Let's just call it 500. 20% of 500 is $100,000. How long is it going to take you to save up $100,000? A long freaking time. But what if you only had to get halfway there? What if you had to get to 50? Okay, 50 is still a lot of money. I'm not poo-pooing $50,000, but 50,000 is twice as easy as 100,000, right? So if you could get to, if you're at $61,000 and you're trying to say, oh, I'm going to wait till 20%, that means more rent payments because you're waiting. That means prices continue to go up because you're waiting. And I mean, interest rates could go up, they could go down. That's kind of a moot point. But if you get in with that 50,000, start building that equity, start paying yourself instead of paying your landlord, get those tax write-offs, all of a sudden you're going to be in a much better position. Don't try to wait to save to get to 20%. If you've got 10, pull the trigger. Of course, if it all makes sense. Can you get equity in a condo? Everyone says condos don't appreciate as much as single family. Yes, you absolutely can get equity in a condo, but everyone's not wrong. Condos do not appreciate as well as single family. And if there is a recession or housing market crash or some type of resistance in housing, condos do typically tend to lose their value quicker than single family homes. And they tend to lose a little bit more value than single family homes. So in terms of like the quality of an investment, a single family detached resident on residence on its own lot, its own house, all that stuff, non-HOA, although HOA is still okay. That's going to give you the best return on your investment. It's going to give you the best, the very, very best return on the investment. Whereas condos, you can still get equity out of it. Certainly, you can still get equity out of it, but they're not as desirable typically. So that's why they don't typically appreciate as much usually. So hopefully that answers your question. With that said, if condo is in your wheelhouse and you find something you like, and then you also have to pay attention to the HOA, right? So you got to take into account your regular payment, right? Plus that HOA. So factor that in. But I being in a condo and maybe getting less appreciation than a house versus not buying a condo and continuing to rent an apartment, condo, or house as you save, I'd go for the condo. The name of the game is equity. Get that foot in the door, start building that equity. The majority of repeat buyers, 54%, said they used the proceeds from selling their primary residence to finance their down payment. I'm surprised it's only 54%. I thought that'd be higher. Meanwhile, the majority of first-time buyers, 59%, pulled from their savings. Well, of course, where else are you going to pull from? It's important to note, though, that the NAR survey uses data from between July 24 and June 25. Since then, trends in the broader housing market have already changed. For one, home price appreciation has slowed. As of September, prices were up just 2% compared to a year earlier, according to data from homes.com. Now, the important thing to realize is that, oh my God, they're going to say, oh, prices were up just 2%. Oh God, it's so low. You guys, historical average is 3% per year. So they're down a third, but the market fluctuates. Some areas have seen much more than 2%. Some have seen much less than 2%. So it just depends. At the same time, the number of for sale listings surpassed pre-pandemic levels. Mortgage rates, too, have come down from their early 2025 highs, settling in the low to mid 6% range, which I do believe they're going to be in this low to mid 6% range for probably the next 24 months or so. That's my prediction. It remains to be seen how these changes will affect the buying and selling experience. Still, new signs are emerging of a rise in home buying activity, including new demand for loans, which is definitely a good thing. All right, let's see where we're at, guys. We're coming. Oh, wow. It's an hour and 13. Time flies when you're having fun. So we're getting towards the end of the stream, but we're not done yet because we're going to share this tab instead. Guys, you know what time it is. If you are looking for a good agent, if you are thinking about buying a property, selling a property, and you want to make sure that you get connected with a good real estate agent, you can head over to workwithjoerealtor.com. I just put the link in the chat. And I am connected with real estate agents all over the country. I've got great referral partners all the way from here to Washington State to Massachusetts and everywhere in between. So if you are sitting right now and you're in Omaha, Nebraska, I got a guy for you, David Matney. He's not in the stream tonight, but I can get you that connection and make sure that you get connected to what we call a 20% agent. 20% agent is an agent that is in the top 20%. They're the agents that take real estate seriously. They're professional. They know what they're doing and they know how to guide you. There's a lot of agents out there that don't know. That's the 80%. And you don't want one of them. I can assure you of that. So if you are looking for a good agent, a 20% agent that can actually help you, and you need a referral anywhere in the United States and even in some areas outside the United States, and you don't know where to start, go to Work with Joe Realtor, click on this Let's Chat button right here. You can click on Book a Time to Chat, Let's Connect, any of these, take it to the same place, fill out a little form, talks about what you need. See, David does rock, doesn't he? David rocks. Yeah, see, I ain't lying. MH, you can fill out the form and I'll get you connected. And some cool news, if you are in the greater Los Angeles, San Bernardino, or Riverside County areas, I can help you personally, right? So anywhere in the LA County, Riverside County, San Bernardino County, so all over those places, if you're looking for a good agent and you want to work with me directly, go on to workwithjoerealtor.com and we can get you set up with a consultation. All All right, guys, it's an hour and 15. This stream has been phenomenal. Lots of new faces. Drew V, thanks for hanging out and chatting. Really appreciate you. If you have questions, please email me. And I better see you in the stream next week. MH, always, thanks for being here, buddy. You're a regular. You got the seat at the bar. Always good having you here. Dan M, if you're still hanging out, appreciate you. Hope you don't hate me too much for not seeing 60 frames per second. Robert G, my good friend. Glad you're here. Glad you're in the stream. Thanks for chatting. You always have really good input, good questions. Glad you're here, buddy. Who else is in here? Who else? Oh, we got Bert. Bert, thanks for hanging out. First time watcher, first time chatter. Thanks for hanging. Good to see you. Good to see you. Innovative, another regular, one of my regular guys. Innovative. One of my buddies just moved to the greater Dallas, Fort Worth area. I'm going to go visit him at some point. We're getting a beer. Whenever I get out to Dallas, I'm going to get in contact with you. We're grabbing a beer because you're hilarious and I like you. All right, guys. Oh, and then Killer Chronicles. Killer Chronicles. Thanks, buddy. Thanks for being here. Again, new face, new chatter. Oh, I missed it. I missed it from Addis. From Audis. It was one of my early clients. And I met Audis playing video games and then I ended up selling him a house. What a great story. And now we're friends and now we play video games together. In fact, we'll probably play video games tonight together. That's what we're going to do. So, all right, guys. So many good things coming in. Thanks so much, guys. Oh, there he is. Hanging out. Robert G, thanks for being here. I'm in LA, but I have an agent. I'll let you know if things don't work out. Yeah, Drew. Hey, reach on out. If you ever need a second set of eyes, ever need anything, come on by. Shoot me a message. But I still expect to see you in the stream. So you better come back and hang out. Yeah, you're welcome. You're welcome. Have fun. Have fun with your bedtime routine. All right, guys. I'm getting out of here. It's time to go eat pasta fajoule. Great. Thanks for hanging out, guys. I really, really appreciate it. If you guys enjoyed the stream, somewhere down here, there's a little like button. Go ahead, hit that. Probably somewhere right here. Please hit that thumbs up, like the stream. If you haven't subscribed, please do subscribe. It's totally free. We're running a promotion, free subscriptions right now. Grab them while they're still available. And hopefully I will see you guys back here same time, same day next week, Wednesday, 6:30 p.m. We'll be talking about more good stuff. And again, I appreciate you giving me some of your very, very valuable time on this Wednesday evening. I hope the rest of your week is wonderful. It's really freaking crazy out there. We got a lot of craziness going on. So try to be nice to someone, be kind, be patient, let people in traffic, and use your turn signal. All right, guys, I'm out of here. Have a great night. I'll see you soon. Bye, guys.